Good morning, everyone. Parag Nevatia from Easy Funding Solutions. We are a business finance management and advisory company in New Jersey. Our website is www.easyfundingsolutions.com. Today, I wanted to talk about another very important aspect which many people don't get. We all dream about being bankable, right? What does that mean? Somebody that trusts you, somebody that can trust you immensely with money or with something that they say. What does it take financial institutions to want to lend you money, right? Is it your credit score that's looked at? Is it just net profit that's looked at? Is it your deep pockets, your experience, um, your location? What is it exactly that brings all this together to qualify your business to be bankable? Back in 2000s, when I was in banking, um, between 2001 and 2007, before the market, the recession hit us, everything that was touched pretty much became gold overnight. IPOs, stock market, mutual funds, the chaos, the positivity, the madness, the lending. Banks were kind of over a handshake almost. Credit score was over 700. Beautiful. Here's 25,000. Here's 50,000. As long as you can show us that you're in business for a year. Try and do that today, right? Credit environment has changed so much. Survival of the fittest. Banks have come and gone. SBA policies have changed. Banking regulations have changed, gotten stricter. Um, in the middle of all this, are you still able to get loans that business expects to get from a lender? And basically, it is coming down to what's in here, right? It's you got to be able to express the fact that you uh, have the ability to run a business and operate a business successfully. Experience is one of the key pieces of the puzzle that probably a few years ago was not really that big a deal. You could have a manager run a business. Yeah, and the next question after post recession, which is great because people started thinking about it, banks started thinking about it. What if the manager gets a better job and leaves you dry and hanging in the middle of nowhere, and you don't even know how to run the business? Heck, you're not even able to get to the business, because you have a 9 to 5 job. I mean, think about these things, guys. It's experience is very important and vital piece of you being able to be bankable. If all you're going to say is I got a manager to run my show, and the bank is not going to be happy to hear that. Clearly, they need an owner to be on top of it and make sure that you're borrowing the money. Therefore, you have the accountability and making sure that the money is being put in the right places, i.e., employees, and employees with experience and expertise in the business. You talk about deep reserves, right? We talk about down payment. There's two aspects of money pocket, your deep pockets that I'm talking about. Two aspects. One is down payment. You need to put your skin in the game. The banks will lend you money. That's one. Second is post closing liquidity. So, do you put all your life savings into a business to be run by a manager? That's a wrong thing, a wrong approach. You cannot expect a bank to to call you bankable if you have no post closing liquidity. You need to have money in your pocket after the loan closes. Okay, maybe depending on the working capital. Do you have 3 months of reserves, 6 months of reserves? Next thing I would like to talk about is the environment, right? Does your potential audience, do your potential clients need your service? Is there a need for your service? Be aware of what's going on in the market. Be aware of the cost of bringing that business, or rather taking that business up off the ground. um, Try and do a lot more research work before you take that leap of faith. However, make sure that you also do take that leap of faith. I've had situations where people have contemplated, and they keep deciding if they want to take the jump, take the plunge. Sometimes 6 months to a year to make a decision. And I think a lot of my banker viewers who are watching this video actually know what I'm talking about, because there have been clients that we've tried to build relationships with, over a year, sometimes more than a year, and they just don't pick up and run. They don't take the next step really to make the business happen. They keep talking, they keep debating, they keep um, talking about it, but they really don't do anything. So again, that's important. Be aware of the market, the location that you pick. Um, don't make decisions in haste. Just because you need to open up doesn't mean you should pick any location that comes across, any fifth location that comes across. Make sure you pick the right location. Make sure the rents are not going to jump on you, because rents, believe it or not, rents and wages are the two biggest pieces of any business, and they can make or break a business pretty soon. Um, so we talked about reserves. We talked about credit. Let's talk about that for a little bit, right? What makes you bankable when you talk about credibility? What is credibility? What is a credit score? It's basically your promise to pay and how you've been accountable to make payments to creditors, if you made payments on time or not, as promised. Um, a credit score between 650 and 700 may not necessarily show anything drastically negative. It might just be what we call debt to income ratio, where your debt is less than your income is less than your debt. You're not able to pay down the debt, basically. And credit scores that are below 650, many a times that's basically because of something that's drastic on their credit report. Anything over 700 usually is assumed pretty safe from being able to lend. So credit score is important, location is important, knowing your business environment is important, having reserves is important, having experience is important. Um, if you're buying a business, very, very important piece, if do the tax returns of the seller demonstrate the ability to sustain the loan? Does it have cash flow? Cash flow, the word cash flow is being used very lightly in the market. It means differently when you're talking to different types of lenders. There's a cash flow analysis or cash flow statement that certain banks follow. There's tax returns, which is what certain banks follow. On the conventional side, cash flow statements are very important for those lenders. On the SBA side, tax returns is what banks go by. So your EBITDA, earnings before interest, taxes, and depreciation and amortization, is what banks look for, and that's basically what cash flow means: the ability to pay back the loan. If you don't have $15 in your pocket, you got 10, you can't get something that's more than $10. Simple logic. You don't need anybody to say that to you. Very simply, the same philosophy is applied to financing. If your cash flow shows you can sustain a $500,000 loan, that's all you can. You cannot sustain a $800,000 loan. Simple as that. Can we add back certain line items from the tax return? Yeah, well, that's to the extent of making it believable. You can add back the entire tax return and say you're highly profitable. You can add back a few of those items and say you're still highly cash flow positive. But it's about the bank to agree to that. So if the bank doesn't agree to a lot of those adjustments, then you still stand basically underground. You don't have the ability to sustain the debt. So cash flow is important as well. One of the last pieces I'm going to talk about is collateral. On the conventional side, um, cash flow, credit, collateral are the three main essential pieces, foundations of getting any kind of loan. Um, Loan, not a line of credit. Now, in the conventional line of credit, usually banks have a rule of thumb. It's generally about 10% of your revenue. Um, so if your revenue is $2 million, you're probably getting away with a $200,000 line of credit. Um, But if your need is 500,000 and you can't get more than 200,000, which is 10% of your revenue, what do you do then? So there's a little twist in this video now. If you're not able to sustain the kind of loan that you really need to get from step one to step two, a line of credit is not going to help you. Then you got to start thinking and saying, okay, maybe I need a term loan to get a jump start or to get to the next leap, right? Um, because the line of credit clearly is not going to give you that ability to take that leap. So keep in mind that it's okay to perhaps look at a term loan and make a payment every month kind of a thing, in form of an SBA 7A loan as well, where the money is for working capital, but it's for the next step. You need to hire three more people, four more people. You're probably going from one location to another location. The next location has more square footage, more tables, restaurant, bigger place. Going from an auto repair from 3 bays to 6 bays, that's expansion. Um, so maybe you need a term loan at that stage. Maybe you also need a line of credit as well on the side, which is a formula driven service product for your need. But on the other side, you may need like a cash injection, capital injection. I'm sorry, in the business. So a term loan is a good solution to that. If you need somebody from outside the bank to prepare you, present you clearly, correctly, so that the chances of approval are like 99%, call us. 732-384-3366. My name is Parag Nevatia from Easy Funding Solutions. We are a business finance management and advisory company, guys. Thank you so much for watching. Have a nice day.